Fed just held rates steady while two members wanted cuts. Unemployment insurance now covers less than it did 90 years ago, and there's a new Fed chair pick that could change everything. If you've got clients wondering what any of this means for their home financing plans, you're in the right place. I am Ron Siegel, certified liability advisor, helping financial professionals guide their clients to build wealth through strategic debt management. The Fed stands pat, but the cracks are showing. Wednesday's Fed meeting gave us exactly what the market expected. Rates stayed at 3.625%, but here's what made this interesting. Two Fed members, Governor Waller and Myron, actually voted for 25 basis point cuts. That's the kind of dissent we don't see very often. Chairman Powell upgraded the economic outlook based on strong GDP numbers and said the labor market is stabilizing. But when you dig into what he actually said in the press conference, the picture gets more complicated. He acknowledged that shelter inflation is overstated because of measurement lags, and he blamed goods inflation on tariffs. Strip those two things out, and we're pretty much at the Fed's 2% target rate already. Here's a number that matters. New rents are down 1.4% year over year, according to the latest apartment list report. The government's still showing shelter inflation at 3.3%. That's a massive gap, and it's making inflation look worse than it really is. The jobs picture gets interesting. We got some eye-opening data on the labor market this week. Initial jobless claims came in at 209,000, basically unchanged. But continuing claims dropped by 38,000 to 1.83 million. Now, that sounds good until you ask the right question. Are people finding jobs or are benefits just expiring? With the weak hiring data we've been seeing, it's probably more about expirations. Remember, most states offer 26 weeks of unemployment benefits. Look back 6 months at initial claims, and we saw some big spikes. Those folks are hitting their time limits now. Here's something your clients should know about unemployment insurance. And this comes from fascinating research this week. In 1938, the average weekly unemployment benefit was $15, and that covered the average weekly income of $10. Today, the average benefit is $471 per week, but that only covers about 33% of what people actually need. That ratio has been cut in half since the 1970s. What does this mean? People are taking multiple jobs and working part-time for economic reasons just to make ends meet. Multiple job holders just hit 9 million for the first time. Part-time workers for economic reasons jumped by 900,000 in just 2 months to 5.5 million. These are leading indicators, and historically, sharp indicators like these don't signal good times ahead. Productivity tells a different story. Third quarter productivity came in at 4.9% growth, which pushed unit labor costs down by 1.9%. That's deflationary, not inflationary. When businesses are getting more productive, they can absorb higher wages without raising prices. The Fed should be paying attention to this instead of obsessing over backward-looking inflation data. The Fed chair succession. President Trump announced his pick for the next Fed chair, Kevin Warsh. He won't take over until May when Powell's term ends, but this matters for your clients' planning. Warsh has been publicly critical of the Fed's approach to data. He understands that the BLS numbers have flaws and that the Fed needs to look through the revisions and measurement issues. He's also said multiple times that the Fed needs to be cutting rates faster. He's less worried about inflation than Powell because he gets that growth can counteract it. Markets respect Warsh, even though he might be slightly more hawkish than some alternatives. The important thing is he's forward-looking rather than backward-looking, and that could mean a more rational approach to monetary policy starting this summer. The mortgage market holds steady. With all this economic noise, mortgage rates have been remarkably stable. The 30-year fixed rate is holding at 6.16%, right in line with the lowest levels we've seen since early 2023, except for that 1 week in mid-January. The 10-year Treasury is trading at 4.246 as we record this. Mortgage bonds are down slightly but holding support at the 25-day moving average. That's been a reliable support level, so we're watching it closely. Government shutdown averted for now. The Senate is voting today on a deal to avoid a government shutdown, and it looks like they have the votes. The House would vote, the House would vote Monday. Your clients with transactions in process should know that a shutdown could mean weeks-long delays for income verifications, tax transcripts, and other documentation we need from federal agencies. Hopefully this gets resolved, but it's something to keep on your radar. As I always say, strategy beats rate always. All of this economic data, all of these Fed decisions, they matter, but here's what matters more for your clients. Strategy beats rate always. The household blended interest rate is what actually impacts your clients' monthly budgets, not just the mortgage rate. When we help families with their home financing needs, we're looking at the complete picture, how the mortgage fits with their other debt, their cash flow, and their long-term wealth building strategy. That's what sets our approach apart. We focus on suitability, not just eligibility. We help families build wealth through strategic debt management. We've got 3 important resources available on the dashboard this week. You'll find these on the right side of the dashboard on the desktop or below this video if you're on mobile. First, a critical warning for anyone adding a teen driver to their insurance. Making one simple mistake could cost your clients $3,200 or more that they'll never get back. Second, we're looking at how 10% more inventory in 2026 creates opportunities, but only if your clients are positioned properly to take advantage of it. Third, we're challenging conventional wisdom about paying off mortgages early. For some families, rushing to pay off the mortgage could actually be their biggest retirement mistake. All 3 of these are available for you right now on the dashboard. Looking ahead, Jobs Week. Next week is Jobs Week. We'll get the JOLTS report, ADP, and the BLS report on Friday. Right now, markets are expecting about 70,000 jobs added, with unemployment holding at 4.4%. These numbers could create volatility. A weak jobs report could push the 10-year Treasury down toward 4.2% or lower, which would help mortgage rates. A stronger than expected report could send yields up to 4.3%. Before we wrap up, I want to remind you about KeySteps, our free financial monitoring platform. This gives your clients credit monitoring, identity theft protection, and budgeting tools all in one place. It's comprehensive household financial monitoring that helps families stay on track with their financial health. You can access KeySteps and share it with your clients at rsrlinks.com/keysteps, rsrlinks.com/keysteps. That's your market update for this week. We appreciate you listening, and we'll speak to you again next week. Have a great week.